Welcome to Chandra Shekher Research Academy of Business Studies, where today we'll dive into the essential concept of debtor management, an important aspect of financial decision-making that impacts both profitability and liquidity in any business. Debtor management is the process of determining the optimum credit policy for selling goods. The goal is to maintain a balance between profitability and liquidity, ensuring the business runs smoothly without jeopardizing cash flow. Let's first understand the relationship between liquidity and profitability. Increasing the credit period might enhance profitability, as more customers will make purchases. But this also reduces liquidity as funds are locked up in debtors. To prevent cash flow issues, the credit policy must strike a balance where liquidity equals profitability. Next, we need to compare the benefits and costs. A longer credit period can lead to more sales, which is beneficial. But the risk of bad debts also rises. This is a cost to the company. Therefore, before implementing any changes, always compare the additional benefits against the additional costs. Only proceed if the benefits outweigh the risks. Managing debtors comes with several costs. First, there's the administrative cost. More credit sales mean more work, like preparing ledgers and maintaining records. Then there's the opportunity cost. Funds tied up in credit sales could have been invested elsewhere, perhaps earning interest in a bank. The lost interest is what we call the opportunity cost. Another type of cost is delinquency cost. This happens when debtors delay their payments, and the company incurs extra expenses to recover the dues. Finally, default cost. This is the worst-case scenario, where the debtor fails to pay altogether, resulting in a bad debt, a direct loss for the business. Let's take an example of a typical credit policy, 3/18 net 45. Here's how it works. A 3% discount is offered if payment is made within 18 days. After 18 days, no discount is provided, and the maximum credit period is 45 days. This method encourages early payment, benefiting both the company's cash flow and the customer. Now let's talk about the aging schedule. This is a method to classify receivables based on how long they've been outstanding. For example, receivables can be categorized as less than 40 days, between 40 and 60 days, and so on. An aging schedule helps analyze the quality of receivables, compare the liquidity of current receivables with previous periods, and assess the chances of recovering overdue debtors.
Now, a popular tool for improving liquidity is factoring. In factoring, a business sells its receivables to a third party, known as a factor, in exchange for immediate cash. The factor then collects the amount from the original debtor. There are different types of factoring. Recourse factoring. Here, the business retains the risk if the debtor doesn't pay. Non-recourse factoring. The factor assumes all the risk of non-payment. Confidential factoring. The terms of the factoring deal remain confidential between the business and the factor. Advanced factoring. The factor pays the business upfront and then collects from the debtor at the due date. In summary, debtor management plays a critical role in ensuring both the liquidity and profitability of a business. Whether through an optimal credit policy or using factoring to improve cash flow, managing debtors effectively helps maintain the financial health of your company. Thank you for watching. If you found this video helpful, don't forget to subscribe to Chandra Shekher Research Academy of Business Studies for more insights on finance and business management. Feel free to check out our other videos on financial management and reach out if you have any questions. Managing debtors is crucial for the health of your small business. It's not just about sending invoices, it's about building relationships. Start by setting clear payment terms up front. This helps avoid confusion later. Regular follow-ups are key. Don't wait until the due date to remind clients. A friendly nudge can go a long way. Consider offering incentives for early payments or penalties for late ones. This creates a sense of urgency. Also, keep your records organized. Knowing who owes what and when can save you time and stress. Lastly, don't be afraid to have tough conversations. Sometimes, a direct approach is necessary to ensure you get paid. Remember, effective debtors management is not just about collecting money. It's about maintaining a healthy cash flow and fostering trust with your clients.